Hello and welcome from me, Philip Nothard, and Curtis Hutchinson to this special Motor Trader Radio podcast interview. Many thanks for joining us for this latest in our series of special midweek interviews themed around sharing insight and best practices across the car retailing community.
And today we're delighted to welcome back to the podcast Mike Allen, Head of Research at Zeus Capital, the asset management firm where he looks after the motor retail sector with a special focus on the listed franchise groups. Now, Mike's joined us today to talk about Zeus's newly published 5 Key Themes report, which discusses 5 challenges and opportunities presented to quoted dealers. These are digital sales trends, electrification, the agency model, vehicle supply, and the economic outlook. This report is only available to professional investors, so we really are grateful to Mike for sharing some of its insights exclusively with us on Motor Trade Radio. So welcome back to the podcast, Mike. It's been much too long. How are you doing?
Yeah, I'm great. Thanks, guys. Really great to be on, and as ever, enjoy the content that you continue to publish. So, it has been a while since the last one. Looking forward to catching up.
Yeah, excellent. Yeah. Well, welcome back.
Yeah, great to have you back, Mike, and certainly a timely report to produce, obviously at this half-year point, as many people start to think about what's happening in this second half of the year and obviously into 2022. So, welcome back. So, as outlined, we're going to focus on the 5 key themes. So, let's start with digital sales. I mean, clearly there's a move to digital, and the omni-channel has been accelerated, as we know, by the lockdowns. But what's your view on the opportunities and potentially the challenges facing dealers, especially with the introduction of the disruptors, as they are keenly themed in the sector?
Yeah, no, I mean, it's a really interesting area, and I think, to be totally fair to a lot of the PLC dealers, they've had this digital infrastructure in place for some time. I mean, I remember Robert Forrest talking 4 or 5 years ago where, people could order a car from the Virtue website and not visit the dealership and it to be delivered, etc. So that's been in place way before COVID and the emergence of some of the disruptors. However, I think it's clear that COVID and those disruptors coming at that time probably accelerated the consumer being ready for that technology as well, and having to need and use that technology. So I think the emergence of the disruptors has actually spurred some of the dealers on as well at a time during COVID. So, for me, I think it's particularly, I think the industry's really raised the game on the back of COVID, and we've seen the impact of that in the financials to date. The business models have been very agile, and I think the consumers now are confident to kind of buy a car purely online and get it delivered if they need to. I don't think it's all about pure digital retail, though. I don't think the industry is going to go completely online and digital. I think that there are customers out there that will still want to transact physically at a dealership and get that reassurance on what's a high-valued service. And some customers will want to flex between, online and, doing maybe some of the boring stuff online and going to the dealership to collect the car and kick the tires with a salesperson who knows a lot about it. And I think the right approach, and we look a lot at the US dealers, and I think CarMax has been consistently the kind of best performing kind of car dealer in the US in terms of delivering value to shareholders. And when we looked at their capital markets day, it was very much kind of, allowing the customer to dictate their own journey between, digital and online. And I think that a lot of the dealers I talk to, the bigger dealers, have got that same strategy, and I think that's the strategy that will work. A final point on the disruptors, because I actually think the likes of Kazoo have done a good job actually in educating different investors. The sheer size of the market opportunity, particularly in used cars. So I think their introduction into the industry hasn't all been negative. I think there's been some positive factors, and sure, there is going to be more kind of competition. But as you know, Phil and Curtis, there's a huge market opportunity there, and I think there will be enough for the Kazoos and the Cinch to get their slice of the market, and the well-run PLC dealer groups as well, in my opinion.
And as you say there, I mean, there was a lot of negativity towards the disruptors initially, and they were coming in to take a slice of the market from the operators already playing in that space. But there's a thought that actually these disruptors have actually accelerated or implemented changes in the current operators, and as you say, it has increased potentially the value of some of these operators in the sector as well, hasn't it?
Yeah, I totally agree, and I think Kazoo have come into the market. They're looking for a 2 to 3% share of £100 billion market, and if they do that, that'll be an extremely valuable business. As we've seen with Carvana, it takes time. These businesses are set up differently. They've got huge marketing budgets. Carvana continues to kind of progress, and Carvana is a Fortune 500 business now, and it's come from nowhere. And I think if Kazoo and Cinch kind of follow that, which they look to be appearing, this is a $100 billion market. There's room for some very valuable purely digital players, and for the PLC businesses to be more highly valued as well. So, I think the emergence of Cinch and Kazoo just shows you how big the pie is to go for, really.
Now, next up, Mike, is the inevitable rise of EV. Now, in your report, you posed the question, how steep is the curve and when does it impact dealers? So would you like to share your thoughts on the likely timeline and the challenges along the way?
Yeah, so I think you've got to look at this from a kind of short-term point of view and a long-term point of view. And clearly, if you look at the latest data from the SMMT on new car sales, last year BEV cars was 6%. This year it's 11%, and clearly, the cars are coming. They've been built. The R&D has been invested, etc. So there's no doubt that these electric cars are coming, and there's a huge political pressure for that to happen as well, and the impact on the environment. But and if you look at some of the projections, and we've done our own projections on this as well, I think the SMMT say about by 2030 they'd expect EV to be 20 to 25% of the total car park, i.e., 20% of the 35 million cars on the road, and that's by 2030. So, it's going to take an awful long time for EV to completely replenish the total car park, and I don't think it's going to happen in my lifetime. So I think, yes, it's rapidly changing the kind of new car mix at the moment, but I think from an after-sales perspective, you've got to look at the bigger picture and the number of cars on the road. And I think, well, I mean, I'm an EV driver myself, and there are definitely some. It's not going to suit every customer. Charging is difficult at the moment, and we need 10 to 12 times more charging points in the UK over the next couple of years. I'm sure that will get addressed, but the technology has to be better and quicker as well. At the moment, it takes, even on a rapid charge, it can take a long time to charge your car, and that takes time out of your day. So there's a long way to go on the infrastructure side. A lot of people won't be able to charge the cars from home, and government opinions on uses of car technology change. I think we all remember, diesel was the green initiative in the early noughties by the government, yes. And who's to say hydrogen isn't the preferred technology in 5 or 10 years? So, I think it does pose a threat to near-term after sales, but it's going to take a long time before it impacts the total market, and who knows, technology might have moved on since then.
And you make an interesting point in the report on after sales. Okay, EVs have less moving parts, they have fewer consumables, but there's an opportunity there on EVs for what you describe as higher value repair work.
Yeah, and I think the other thing is, who knows what will happen with connected cars, and I guess we'll come on to this with the agency model as well. But the OEMs will be in a better position of power to dictate, how many people can kind of service these cars, and with the use of connected cars and with an agency model, with less competition, they can, direct more throughput to the existing network. So, there's a lot of variables at play at the moment, and I think, some people will just say, well, there's less things to go wrong, with an electric car versus an internal combustion car. By the way, we don't know what happens when batteries go wrong, because the cars are still pretty young. So I think the picture is more complex than to say 40% less after sales revenue based on the number of parts. We've not seen a full cycle of an EV being bought and sold several times as we have with the ICE cars.
And part of that higher value repair work will be, as you say, we don't know what happens with batteries, but they will need to be maintained or replaced at some stage.
Yeah, exactly, and we just don't know, how that will work. And interestingly, I think Phil, you've talked about it before as well, but residuals on BEV cars are a little bit more volatile than what we see on standard cars, just because there is these uncertainties to kind of consider further down the line. Yeah,
very, very true. It is an unknown, and it's not like an evolution of the combustion engine. It's new technology, new pricing structures and residual values, everything that, at what point will we get price parity? At what point will used EVs then be supported through the UK government and things like this? So there's still many questions outstanding for the EV sector.
Yeah, no, totally agree.
So moving on to vehicle supply, and the next key theme in the report is vehicle supply, and you've themed this around asking the question, when will it buy? Many dealers are already feeling the impact, as we know, of how worse, but how much worse can it get? Is there an end in sight? And something I talk about a lot is, obviously, we've seen the impact of COVID through 2020 and into 2021, what that's done to the new vehicle supply. But actually, previous to that, we had RDE and WLTP and the taxation and benefit in kind and everything else that was going on in the new vehicle space that was changing the vehicle supply and that value chain entering that used car marketplace. So what are your thoughts? Do you want to share your thoughts on what you think about the vehicle supply now as we head forward?
Yeah, I've been looking at the sector for over 20 years, and I've never seen a situation like this. I've seen plenty of oversupply during that time, but never such a chronic undersupply at the moment, and obviously we've got a unique set of circumstances with COVID and ramping up, supply chains, etc. And we looked at kind of, there is some new capacity coming on because there is this is seen to be a problem over the next year or two. But the big question for me is, where is the automotive sector on the in terms of the pecking order relative to other heavy semiconductor users? Is it towards the bottom end of the sector list of priorities or not? You look at some of the announcements of what Intel have been saying. They've been talking about delays until Q4 22. And we've seen from other industries as well that they're talking about 2 years of disruption. And it's interesting when we talk to dealers and OEMs about it, and I think it's as ever. There's OEMs have got different. Some of them. I think it's a risk factor, but I think some OEMs are managing it better than others. Some OEMs are saying, well, you might not get the car in September, but you will get it by the end of the calendar year. Others are taking a much more bearish view and saying this is going to be an issue going into next year. So as ever, I think it's a complex picture. In my view, I think it is going to almost certainly disrupt the September market, and I think the most bullish interpretation I've heard is kind of, but we'll get it back by by December, by the calendar year. I think a more realistic view is this is probably going to be a headwind going, particularly the first half of next year as well, that we've got to consider.
And what is the, from a financial investor's perspective, because obviously we've come through the first half of the year, a lot of that was stock and pipeline availability, pent up activity that where those that didn't want to do a click and collect and they wanted to go and visit and things like that after the first quarter of the year. But as we head into this, through the second half of the year, as the economy starts to open up again and people's focus, consumers' focus, sort of go elsewhere, how optimistic or cautious is the financial sector towards the automotive industry in this second half of the year with all these dynamics at play?
I think if you look at the share prices from last year, the share prices have all moved in the right direction. However, what I would say is those share price reactions have been based on earnings upgrades that all of the dealers have kind of delivered over the last 12 months, and they've certainly bounced back a lot stronger than definitely we expected when we were in the depths of the first lockdown, etc. So I think that the share price gains have really been driven by earnings upgrades. I think if you look at the valuation of the sector is still very low, and I still think the sector isn't getting the credit for the agility and operational excellence many of these businesses have kind of shown in very, very challenging times. So I think I don't think the valuation of the sector has been addressed yet. And as ever in the automotive sector, there are always going to be complex problems that occur and, things that we've got to work through. And as you alluded to before, Phil, it was Brexit, WLTP, RDE. We've now got a supply issue. There'll be something next year that the sector works through as well, So it's, but I don't think their valuations give the credit for, how well these businesses have been run.
Yeah, I think they've, we constantly say it when there's a headwind facing the sector, and we talk about the resilience of the market, and how many times have we been through it. The financial crash was obviously the most obvious one recently, and we saw what came out of that, and again they'll work through it and they'll be very resilient, won't they?
Absolutely, yeah.
Now, Mike, talking of headwinds and tailwinds, next up is the agency model. And you'll know this is a frequent topic of conversation on the podcast, especially following recent moves by Stellantis, who terminated its network with an agency model expected to replace it by 2027. We've talked about Mercedes announcing it would be consulting with dealers about a future agency model, and VW looking at the adoption of EV sales by the start of 2023 under an agency agreement. So what's your analysis of the likelihood of the agency model fundamentally changing or replacing the current franchised model?
Yeah, I mean, I think there's definitely a push. I think every manufacturer is looking at the agency model at the moment, and my theory on this is probably, management consultants were pushing the ideas hard to OEMs when they were stuck at home during COVID, and it's kind of sparked a little bit of a light bulb moment off with OEMs, and I think they're all looking at it and considering it, and some will go down that route, some will do it just for EV cars, some of them will kind of reject it. But I think, it's part of this acceleration and change post-COVID. I think in theory, an agency model isn't terrible. So businesses that are typically more asset light tend to get higher valuations. So an agency model in its purest form, there probably should be scope for dealers to scale back a little bit on cost. They might not get the same amount of money on a per unit basis, but and this is where it becomes difficult in terms of, what does it mean from a kind of cost point of view? Does the OEM share more of the costs now they're closer to the consumer or not? What happens with approved used cars? Do the dealers, have to share that? What happens with the network sizes? I mean, clearly the dealers have to make an economic profit, and the agency model might result in 40-50% cuts, to the network. So those operators that have chosen to adopt the model will have better territory economics, etc. So there's a lot of things to consider really before you can do a true kind of financial analysis. But I think the idea of not having the kind of stock investment and you're making a profit in a less asset intensive way isn't necessarily a bad thing. And the agency models have been around, in the parts industry. We noticed when that went to agency, there was a huge uplift in cash generation. I think there's areas of fleet that have gone agency as well. And I think it was ICDB, Steve Young was talking about the adoption in Sweden and
yes,
South Africa, Australia, and the experiences there have been, the customers are happier, the retailers are happier. Now, it all depends on the detail, and it all depends on the dynamics in terms of, network reduction, cost contribution, and the parameters around the other revenue streams in the business as well. So, I don't think it's necessarily bad news, but I think, I'd be really interested to see the kind of detail and almost a compare and contrast of a P&L on an agency basis and the conventional basis, just to understand how the numbers are likely to move around.
Yeah, and in fact, what will you say about that lower investment in stock? That was actually cited by Dash Gupta, CEO of Marshalls, when we interviewed him on the podcast, and he saw that as a positive. So we are seeing some sort of welcoming signs from the dealer community.
Yeah. I mean, I think it's less capital employed, higher returns, and that typically normally lead to higher valuations. I think the problem we've got is there's going to be a lot of different interpretations of this model, and the dealers aren't suddenly going to go to a pure agency model next year where we can see that impact. I think it's going to be quite a muddied picture on it over the next couple of years, but hopefully, there's an inevitability of agency, and we'll be tracking closely how companies are improving their return on capital employed as a result.
Actually, you raise a really good point here, Mike, because potentially on a multi-franchise site, that dealer could be operating different types of agency models by brand, all under one roof.
Both with and without agency.
Yeah.
Yeah, so as ever, and I think it's complex. It's a complex sector, and I look forward to seeing the kind of the blueprints of what it looks like, and looking at the kind of unit economics. I think is where we will get the kind of clues, and as you say, tracking kind of return on capital, I think will be pretty key over the coming years.
No, I think you're right. I think there is this transition period. There's potentially this sort of the hybrid options. It's not going to be black and white, is it? That's how an agency model looks, and that's how a conventional sales process looks. There's potentials in between, because some manufacturers are better placed than others in terms of distribution networks and import channels and cash flow and profit. So I think we're just going to have to watch it, but there's a clear intention in there for the sector that there is this transition towards agency models for many of the OEMs.
Yeah, absolutely.
So finally, of the 5 key themes, and we did touch on it slightly before in terms of the near-term trading and that economic outlook. And what's your analysis of how trading and the economy are likely to pan out over the coming months, probably till the end of the year? There's talk of recruitment issues across the sector. We've got discussions around unemployment levels, the end of furlough. There's block exemption now entering conversation. What's your outlook for the sort of the near-term trading and the economic outlook?
Yeah, look, I think the demand side of the equation has been remarkably strong, and I think particularly the consumer confidence, we've seen a steady increase in that data from October last year, which has been really good to see. I mean, obviously there's been kind of government support in that with furlough, etc., and the government's played a big role, I think, in terms of getting the confidence levels kind of back. Hopefully, we're on a kind of a trend of long-term recovery, and one of the economists we use expect GDP to return to pre-pandemic levels by Q4 this year, which is great. We're keeping an eye on the consumer confidence data, and we think there's a strong correlation there with consumer confidence with particularly new car sales, but clearly we've got to take into account the supply issues that we've been talking about. But and obviously the latest data on COVID looks good, but clearly we're not completely out of the woods yet, and we probably can't 100% rule out any kind of lockdowns autumn, winter time, but hopefully we're close to a fully vaccinated UK population, and hopefully we'll learn to live with COVID and manage the risks. So the demand side to me looks very good. I think that you touch on a very interesting point in terms of labour shortages, and also inflation are kind of going to be key things to that people need to manage well. I mean, it's clear with the people that have been on furlough, and we've seen this in other sectors as well. Some people don't want to go back to intense full-time kind of work. So we are definitely seeing, labour challenges, particularly probably with after-sales technicians, with drivers, etc. So I think that's a challenge. And then, we've got to look at inflation as well. And, again, over the last 20 years, that's not something we've really lived with. I mean, prices have been remarkably stable. And, I think if we start to get inflation, above 3%, and, I think it's manageable in the next year or two, because we're expecting growth levels of 6 to 8% this year and next year. But I guess the danger, going forward is probably, if inflation starts to exceed growth, then that will be challenging, particularly with, the motor retail sector that have high fixed cost bases. Although those high fixed cost bases will probably be coming down with the agency model. So, I think the economy has definitely performed better than expected, and then it's the next big question is, when do interest rates go up? And they're talking about second half of 2023. So we might have a year or two of that, but there's only one way interest rates can go, and it is an interest rate sensitive kind of area. So I think I think inflation and interest rates and availability of labour are things that we've got to keep a close eye on. And demand has been strong, but pent-up demand doesn't last forever. And we've had it for a year now, so we've got to look at that closely as well.
Yeah, you're right, and like you say, all those questions around inflation and it does have an impact on what we are facing. We talked around right at the start of the show around this supply of new vehicles, because some of that is around the cost of raw materials, and those prices have been continually rising, haven't they, throughout the back end of the pandemic and into this year, which is adding further pressure on production output because of the costs of supply of raw materials.
Yes, no, absolutely.
I mean, in fact, great, and we could talk forever about the report, because it's a very detailed and comprehensive report, as Curtis pointed out there at the start of the show, and some interesting topics there. And we on the show we've talked around EV and vehicle supply and agency model, but actually looking at it from an investor's and an economic perspective and financial perspective gives a different view on it from a less operational side of things. So, as always, Mike, it's fascinating that what you've been sharing, and we shouldn't leave it as long for you to come back on the show in the future.
Yeah, no, sounds great. Really enjoyed it. Thank you.
So, in terms of getting hold of the report, as Curtis mentioned at the start of the show, that it is only available, it is exclusive to professional investors, and so the best way, I think, Mike, is probably to reach out to you on LinkedIn. Would you say anybody that is interested in getting hold of the report, that they reach out to you probably via the LinkedIn? Yeah,
that's right. Yeah, I think that's the best way.
And it's just Mike Allen at Zeus Capital there on LinkedIn. So they say, and worth connecting with you anyway, just to get your shares and your updates on things. So again, thanks for coming on the show today, Mike. It's been an absolute pleasure as always. Very thought provoking as we knew it would be. So again, thanks for tuning in and listening to us today.